How's it guys? Peter here. It is that time of the year where I'm going to reveal my total investment portfolio with you guys, going over where exactly I invest all of my money, how it is diversified across different asset classes, and I will also be giving you my reasoning behind my investment decisions. Now, I made a similar video about a year ago if you want to go check out how my investment strategy has evolved over this time. But this year, I'm going to pull both me and my wife's investments together and give you a proper overview of how we manage our investments as a married couple. We decided to do it this way because being able to leverage the income and wealth of two individuals will get us to our goals much faster. Now, as you know, this channel is all about complete transparency. So this year, I will reveal the actual numbers as well, so that you guys can see a real-life example of an holistic investment strategy that takes everything into account. Again, this is by no means a way to flex or brag. I'm sharing this very much personal information as a means to help educate others with the hopes to inspire someone to take charge of their own finances as well. Okay, klaar gepraat. Let's get into this video. Now, the vast majority of our investments are invested in unit trusts, which is around 494,000 Rand or 40.5% of our portfolio. And this is split up between 90% actively managed and 10% passively managed unit trusts. Hi Bob Peter, I thought you said actively managed funds are too expensive and that you always advocate for cheap passively managed funds. Well, yes, that is true. So let me explain by giving you a bit of a background of our investment journey. I graduated in 2019 and my wife in 2018, both as veterinarians. So I started investing my money in 2020 and my wife in 2019. We had a bit of money in savings prior to this, mostly from student jobs and pocket money we received during the years. But our story will begin the day that we started earning our first salaries. Now, like most people graduating, we didn't know jack about investing and finances. I've always maintained a rather frugal mindset when it came to money, a mindset which was passed on to me by my parents, and I knew that I needed to invest as much money as I can. That's it. So when my first paycheck arrived and I was done crying after seeing my tax deductions and debit orders going off, I knew that I had to put at least some money away. And as any logical person would do, I contacted several financial advisors to help guide me through the process. I ended up with one from PPS who advised I open a tax-free savings account and a retirement annuity and invest as much money as I can into it, which was sound advice. My wife did the same. And so for the first 18 months of my investment journey, we put all of our investments into our PPS retirement annuities and tax-free savings accounts. We both got a lekker vet tax refund from our retirement annuity contributions, which funded a magical holiday in Croatia, cementing our engagement. Now, I always had a keen interest in finances and numbers, so at the start of my working career, I made a point to read as many financial books and blog articles as possible, and as soon as I started to get a grip on how investments work, I realized the importance of the compounding effect, not only for your investment returns, but also from the fees that will erode your investment returns. I learned that actively managed funds charge more because they have experts managing the funds who tries to beat the average return on the market, which is statistically nearly impossible to do consistently over a long period of time. But what is consistent and predictable is the fees that you will pay. And if the fund does badly, you will still pay the same fees. So as I delved into this more deeply in 2021, I took the leap of starting to invest my own money by opening an easy equities account as well as a low-cost passive retirement annuity from Signia for both my wife and I. So ever since July 2021, about 18 months ago, I started managing the majority of our investments myself. Now, I decided to keep our actively managed tax-free savings account and retirement annuities with PPS and continue to invest the minimum debit order amount into them every single month ever since. So why didn't I just transfer them to passively managed funds? Well, mostly for three reasons. Firstly, Although the fees on these actively managed funds are higher than the passively managed funds, they are still within reason and are not absurdly high as most other insurance companies. I actually did have another RA with Sanlam whose fees were atrocious, which I eventually moved to Signia. But our PPS funds, we decided to leave there because it was still within reason. Secondly, I want to kind of track the performance of my investments when compared to the experts to see who will perform the best over a 1, 3 and 5 year period in order to generate a real life case study for the active versus passive investments debate. And thirdly, I'm a vet, not an asset manager. I was trained to treat animals, not to manage investments. I fully acknowledge the fact that I am not a professional in this field, so keeping some of my investments in the hands of the professionals kind of acts like a hedge against myself and the risk that I impose on our investments. But yeah, moving forward, I will invest around 90% of our monthly contributions myself because I enjoy it and I can use it to help educate you guys on how someone can actually learn how to do this themselves. However, if you are still new to the investing world and do not fully understand things like risk tolerance, asset classes, taxes on investments, and retirement funds, then I would always advocate that you rather consult a professional, independent, fee-based financial advisor to help get you started. And the more you learn, the more confidence you will build, and the more money you can confidently start to invest yourself. Right. So just to give you a further breakdown of our unit trust investments, 50% is invested in our actively managed retirement annuities from PPS, 10% in passively managed retirement annuities from Signia, and 40% in actively managed tax-free savings accounts from PPS. Now, as our investment portfolio grows, the actively managed portion will shrink and start to dilute away. So although it still makes up a rather large portion of our portfolio, I do not really plan to move it over to passive funds as of yet for the 3 reasons I mentioned earlier. Okay, so Peter, what are these passively managed funds that you talk about? Now, I already mentioned our passively managed retirement annuities from Signia, but the ones that I'm mostly referring to are our ETFs or exchange traded funds. ETFs tend to be much cheaper than unit trust because instead of having a professional who actively tries to beat the market, they simply track the average performance of the market. They are by far the most favorite investment product for passive investment advocates because they are cheap, well diversified, and stupid easy to buy. ETFs currently make up about 14.9% or 182,000 Rand of our investment portfolio. 45% of these ETFs are invested in our tax-free savings accounts on Easy Equities, 16% is invested in US domiciled ETFs on Easy Equities, 17% is invested in Rand domiciled ETFs also on Easy Equities, and 22% is invested in Irish domiciled ETFs on Interactive Brokers. Now, I am aiming for the majority of our investment portfolio to eventually consist out of ETFs, and therefore I'm investing the vast majority of our funds into them moving forward. Now, the great thing about ETFs is that they are well diversified. You can buy one ETF and then automatically own shares in the 500 biggest companies in the US. So for beginner investors who want to invest themselves, ETFs are a great place to start. But because ETFs are relatively safe investments in terms of spreading your risk equally, they are not too exciting. And seeing that I love learning new things and that I want to create good quality content for you guys, I decided this year to dabble in the dark arts of individual stock picking, which currently makes up a whopping 3.2% or around 40,000 Rand of our portfolio. This is split up between 66% US individual stocks and 34% local individual stocks, both of which are invested on the Easy Equities platform. Now, I explain exactly which stocks I own and why in my investment portfolio update series if you guys want to go and check it out. I want to keep this portion below 5% of my portfolio, mostly because I only do this for fun and that I do not subscribe to the illusion that I can actually pick winning stocks that can beat the average return on the market. But hey, a man can try, right? Then we also have a measly 3,500 Rand or 0.3% of our portfolio invested in property through the Easy Properties investment account. Again, I only use this investment as a way to diversify our portfolio and to learn how the platform works so that I can create great quality content for you guys. We actually also own a part of a property in the Durbanville area, but this has been bought with some inheritance money together with my other siblings, so I decided not to include it in this video as I wanted to give you guys an accurate reflection of only the money we invested from our monthly salaries. We currently have no money invested in bonds apart from the exposure that we have from our actively managed unit trust. We still have another good 30 years left to invest, so we do not need the monthly income that bonds provide at this stage. Although the retail savings bonds do offer really attractive rates at the moment, so we might invest a portion of our cash into 1 or 2 retail savings bonds in order to capitalize on the high interest rates and to further diversify our portfolio. And of course, there's also crypto, which currently makes up 2.2% or 26,500 Rand of our total portfolio. This is split up between 40% in the top 10 bundle from easycrypto.co.za, 24% in the top 10 bundle from Revex, and 36% between Bitcoin, Ethereum, and Dogecoin, which is kept on the Exodus software wallet. The crypto market is mal at the moment, especially ever since the downfall of corrupted crypto exchanges like FTX, Celsius, and Voyager Digital. Now, I've spent quite a lot of time the past couple of months to educate myself on blockchain technology, and as such, I am still a strong advocate for cryptocurrencies, especially blockchain technology, and will continue to invest in it every single month. But as most experts agree, crypto is still seen as a high risk, high return asset class, and therefore you should only invest between 2 and 5% of your total investment portfolio into it, and this should be money that you are prepared to lose. Our crypto portfolios got hit hard this year, but I will not sell and will continue to buy into Bitcoin, Ethereum, and the top 10 bundles from easycrypto.co and Revex every single month. If crypto goes on another bull run, then it will be a nice boost to our portfolio returns. But if it does not, then it won't affect us too much, as it still makes up a very small part of our total investment portfolio. And then lastly, around 475,000 Rand or 38.9% of our portfolio is actually kept just in cash. And I know what you are thinking. Pieter, is jy simple? That is way too much. Why don't you just gooi it all into the market to buy the dip? Well, several reasons. Firstly, I registered a business through which I earn all of my income, so I still have another 10 months of taxes that I need to pay to our lovely beloved SARS. Secondly, we try to maintain an emergency fund that needs to cover at least 6 months of our living expenses. This fund needs to be kept in cash or ultra conservative investments, as we will need to have quick access to it when needed. Thirdly, having some extra cash on hand is always a good idea, especially if a great investment opportunity comes your way and you want to pounce on it. Fourthly, considering the recently interest rate hikes, the return on cash investments looks a lot better than they did a year ago. So it therefore makes them much more attractive investments because they are still low risk with a decent medium return. And fifthly, we actually wanted to buy a new car and were saving for a lacquer fat deposit. We eventually decided against it, and I will soon make a video as to why this is the case. Alright, so our cash investments are split up between 7% in our normal check accounts, 37% in our FNB savings account, 11% in our FNB 32-day flexi noticed fixed deposit accounts, 23% in the Gold Save accounts from TimeBank, and we use 22% of our cash for crypto arbitrage, which is an alternative investment which I am currently testing out and will also soon make a video about. Now moving forward, I'm going to open a money market account for both my wife and myself, which will channel most of the cash that are currently sitting in our FNB savings account into. And if you want to know what exactly a money market fund is and why it is much better than just a normal bank savings account, then go and watch this video. We will also continue to make lump sum investments into the market as we move through the lows of the looming recession, as we know and understand that although our portfolios are down at the moment, everything is still currently trading at a discount, and we therefore want to capitalize on this opportunity. So taking everything into consideration, my wife and I, after a combined 7 years of investing our money every single month, currently have an investment portfolio of just over 1.2 million rand, which is split up between 40.5% unit trust, 14.9% ETFs, 3.2% individual stocks, 0.3% property, 2.2% crypto, and 38.9% cash. Now it is great to be able to look back to see how far we've come. And I'm really excited to see how much this portfolio will grow and expand to into the future. Now I really hope that this video gave you guys some insight as to how one could go about setting up and diversify their investment portfolio, and to somehow get you excited to start your own journey as well if you have not already. Investing can seem quite daunting, but true wealth is built over several decades of consistently saving and investing every single month through the highs and the lows. So please do not feel discouraged if you feel like you are behind. The important thing is to start where you are now and to learn and grow every single day. And remember, our investment strategy is what works for us based on our risk tolerance, investment time horizon, and what we've learned. So if you are still new to investing, then rather consult a professional financial advisor to help get you started, and then you can learn as you go along. Thanks for watching, guys. Feel free to let me know down in the comments if you guys have any questions regarding our investment portfolio and asset allocation. I'm always excited to hear what your thoughts are. You must all have a Merry Christmas and a blessed time with family and friends. Cheers!